Okay, let's get started. The purpose of this is to do a quick lecture which knocks out a few of the pages in the lecture notes that we were going to cover last week. They're important, but they're not terribly important. And they're things that I think if I can knock them out and you can watch them in a video between now and next class, then it'll save time for next class that we're sort of losing tonight, missing class. I'm going to be covering basically pages 10, 11, and 12 in your lecture notes. The end of chapter 12, the behavioral finance chapter, has to do with technical analysis. And in the chapter on the efficient market hypothesis, we talked about how there's a belief that most of the past prices of stocks, meaning if you look at a chart of the price of a stock over the last year or two, you can't really glean anything out of it as far as predicting where the stock's going in the future. That's what the efficient market hypothesis would tell you. It would make you believe that no information can be gained from that. To make it predictable, to allow you to gain abnormal returns, which therefore you could execute as a trading strategy to capture those abnormal returns. The efficient market hypothesis would tell you that's not possible. What I want to show you tonight is a bunch of different things people do, because most people, not most, many people believe that you can look at charts to get a feel. So I'm going to go down these 3 pages and try to bring in as many examples as I can. These aren't really topics for homework and test questions and stuff, because it's not so much numbers. It's more things that people do, techniques people use. I need to expose you to them so that you can see them. Some of them will click with you and you'll think that makes sense, that's interesting. Some of them won't, and that's fine. But by the time that you've considered all this, you need to decide if looking at a chart when you're buying something makes sense or not for you. Most everything is going to be on the monitor. I'm going to try to do the lecture focused on the monitor. I may write a few things on the board. I zoom the camera in to the board, so if I do, hopefully you'll be able to see them. But starting here at the top of page 10, the whole purpose of technical analysis is, can you look at a chart and find a trend? Obviously, you're looking for a trend either going up or down, and you're going to make a trade based on which way you think it's telling you it's going to go. It's a search for momentum. Usually that means up, but it can be going down. And finding that and having it suggest that it's going to continue. The more likely you can find a trend, then the more you're saying something is predictable, and that can lead to trading strategies which allow you to gain abnormal returns. So if I go to Yahoo and just bring up Panera's chart, it looks like this. And my question for you is, does that chart tell you anything? This is a 2-year chart. The stock's basically gone back and forth between 150 and 190 several different times. So looking at this chart, does it tell you anything? Well, that's for the eyes of the beholder. I'm going to go through a few things that might convince you that maybe you can draw something from this. The first thing I want to talk about is 50-day and 200-day moving average. So the chart that I just showed you shows you the price on each given day as it's moved through the past 2 years. What technicians do, and chartists, that's what they're called, people who use technical analysis to come up with stock strategies. They calculate a moving average of the price. So they'll take either the last 50 days or the last 200 days. These are the most popular. And they average them up. 50 days is 10 weeks, and 200 days is 40. And so one's considered long-term, one's more short. Both are less than a year, but you take up those 200 prices, take an average, and on that day you plot that average. The chart below here shows that, and the black line, this is Intel, is the price, the actual price chart, but the blue line is the 200-day moving average, or in this case, it's the 50-day moving average. And what a moving average will do is it'll smooth out the chart. Charts will be very up and down. Taking an average, especially the longer it is, it will smooth that out. And when you plot it alongside of the actual price chart, you can start trying to, is the chart telling you something? Well, the first thing you look at is the current price trading above or below where the moving average is. So in this case, it's going up and down for both, but what the letters are showing you is at this point over here, A, the actual price on that day of the stock started to move above the 50-day moving average. So if you took the price for the last 50 days, took an average, plotted it, that's the blue line on that day. The stock crossed it at that point, and that's called breaking out. The stock is below it, and it's reached the moving average, and now on that day it actually broke through from the bottom going up, and that is a very positive sign, because what it's saying is that the price now is trading at a point higher than it's traded on average for the last 50 days. And what you see is soon after that, if you just follow it, the stock keeps going for the following couple months. It comes back down and touches the blue average and then takes off again and trades along. So when it breaks up that way, that's seen as a positive. If you go over to B, it's just the opposite. The stock has been above it for several months, and as a result, the blue line keeps following it up and up and up. And then at this point, the actual stock price breaks through and starts traveling below the moving average. This is seen as a very bearish, negative sign. It means that maybe the trend has switched and the stock is no longer in an upswing, but it's in a downswing. So that's how those two are interpreted. If I go back to the Panera, I want to show you how you put these on the chart. At Yahoo, if you go over on the side here and pick interactive or basic charts, it's going to bring up this price chart. If you want to add things to it, you can do that up here on the toolbar. I picked 2. You can pick whatever range you want, but if you go under indicator, the first one says simple moving average, and you click on it, and it says 50-day. So you see that I've done that, so it's drawn the green line in there. That's the 50-day moving average. If I want the 200 also, click plus again, and it puts 2 of them there. And if you go to this little pencil here, it's edit, and it brings them both up. So the green one's going to be 50, and I'm going to change the other one to 200, and it should draw both of them in there now. So this is Panera, and I've drawn in the 2 moving averages. So there's various points here where, well, let me back up. The red line is going to be much smoother and flatter because it's a longer average, 200-day moving average. The green is the 50-day, and it's going to move much more with the price chart. Things that chartists look for is when it's crossing below and above. So I'm sure down here they thought that was very positive, that it broke out and was moving up. And then here it broke through its 200-day moving average and got above it. I assume they took that to mean very positive as well. I will tell you this. Today, Wednesday, Panera announced earnings, and they were bad, and or a disappointment, I should say. And the stock's actually down pretty significant today. But I still think it's probably trading above its moving averages. So the other thing, which we'll talk about in a little bit later, is when these 2 averages cross each other, that's very significant as well for people who interpret this stuff. Let me go back to the lecture notes. So that's what moving average is. That's how they use it. Another one, while I'm here, another one you can do that people watch a lot is the actual S&P 500. I'm just going to do the same thing with it. It's already drawn them in, because that's what I had before. So this is a 2-year chart of the S&P 500. And you can see that it has been on a constant rise for the last 2 years. So the two averages are on a constant rise. Let me actually take this down to year to date so it's bigger. Over here, this is 2 weeks ago, or in the last month we'll say. The stock price broke through its moving average, 50-day, kept going, and then broke through its 200-day moving average and kept going. This was significant. This was in the news every night for like 3 or 4 days that the market has technically broken down. And what that means is there was something going on the chart which was a big negative. And what it was is that it broke through its two moving averages. You will see, though, that soon after that, meaning in the last week or 10 days, the stock market has taken off and gotten back above them. I'm going to play you a video here in about 5 or 10 minutes where have someone explains this, of what they think is going on. Let me go back to the lecture notes. So that's the S&P 500. You can chart it. Index, you can chart a company, whatever you want. The next one on your list is relative strength. And in your textbook, and you may have had a question on this, I don't remember. Relative strength is when you take the price of your company stock and divide it by either like the industry index that this company's in, or maybe you just divide it by the S&P 500 to see how it's doing relative to the market. But if you do that every day, you take the price of the stock and the price of the index, you see how they're both moving. And the relation between them will tell you whether it is performing better than its index or performing worse. If it's a rising price, if that ratio is rising over time, it's telling you that the ratio between these two is telling you that the stock is outperforming its index, and vice versa. If it's going down, it's telling you the opposite. Similarly, if I go back to here, I'm going to go back to Panera. And you go to this indicator again, and one of the choices is relative strength. So you go down to it, click it, and it's usually a separate graph. Let's see if it drops it in. It leaves all the other ones there that we had, and now below the chart, they've dropped in a relative strength graph here. And as you can see, I believe, I'd have to look this up for sure, but Yahoo, I believe, is putting it against the S&P 500. It might be putting it against itself. There's ways to do that too. Your relative strength against yourself over at the previous time period. So I'd have to look and make sure. But as you see it here, from really April on, this stock has shown relative strength. It's done well. Previous periods back here a year ago, it was not. It was showing very much of a decline through that time. Once again, this is just another indicator. The chart is showing you. Nothing on here is about the future. Everything on here is about what's happened. And it is something on this chart telling you where this stock could be going. That's the whole purpose of technical analysis. So that's how you do relative strength. Going back here, this is probably a good time for me to add a couple other things. Let's do, let me go back to the graph. There's something called Bollinger Bands, and well, I won't write them on the board. I'll just bring them up. I'll bring it up on the thing, and you can see how it's spelled and what I'm talking about. Up here under the indicator thing, I'm going to take the moving averages off so it cleans up the graph. And then down here, It says Bollinger Bands. John Bollinger invented these way back when. And what it is it takes the moving average. I believe, I don't know which one Yahoo is using, but it's probably telling me right here, but I don't know how to interpret these numbers. It takes the moving average over a certain period of time, and then it takes one or two standard deviations from that number, and then it graphs those numbers. So it's graphing the a band, a area around the stock price over a period of time relative to where the average price has been. And so what does that do? It's giving you an upper and lower boundary. So you see how these bands spread around the stock price. The stock price, so the bands have to do with the moving average. The stock price is moving on its own. So when it takes off and gets well ahead of its moving average, that's what happens over here. And you see the stock is touching the top limits of this standard deviation band. I don't know how to interpret that. Some people would say maybe that's when they sell it because it's shown such strength. I know people often buy the stock when it's touching the bottom band. It's basically showing you times when it's far away from the average. And as you see over the 2-year period, the band goes around the thing and the stock goes up to it and down to it. And people use this to determine, for lack of a better word, the relative strength of this stock relative to its average. Another thing I need to talk about is support and resistance. It's not in your notes. It ties right in with all this stuff, though. And one of the articles I had you read last week, or for this coming week, was the 6 charts everyone needs to see. Well, earlier I mentioned that the stock market was breaking through certain technical, there were certain technical things going on. The market was breaking through its moving averages, and a lot of people started panicking as to what, how to interpret this. Was the market, has it topped, and now was it headed for a big decline? So these charts are all things similar to what we've been talking about, and there's something called support levels and resistance levels. And let me see if I can find the best one that shows them. Let's do this one. So this is the NASDAQ over the last several months, a year. And whenever the stock chart goes up and down, but it comes back to a point where it bottoms and goes back up, and it just seems to not go back below that, that's called a support level. So this line here, you see going across here, has been a support level back 6 months ago. Why? Because the market went up, it hit it here, it went up, it came back down, it hit it, it didn't go through it, it rebounded, it went back up, came back down, hit it again, and then took off. So this level here, back during that time period, was called a support level. It's a level where it appears that buyers will come in and buy the stock or the index or whatever this chart is for, so that the price doesn't keep falling more and more. It's basically a belief that there is demand at that price level which will keep the price from falling through that. As time went on, another support level got made up here where it goes up, breaks it, comes back, takes off again, comes back and hits it. So there's another support level here at this 4,300. So analysts look at these support levels and they look at when stocks break through them. So 2 weeks ago, the NASDAQ here broke through its support level. That means it went through the level where people were willing to support it. And then what they do is they look for, well, if it broke through one, when's the next level of support? Well, for this one, they're saying it's all the way down here. The other side to this, let me see if I can find a chart showing resistance. These are all about support because that's what was going on. Resistance is just the opposite. It's when a stock goes up and touches. It's kind of like, there's not a line here, but it's like right here, there's appearance of a short-term resistance, because every time it gets to this point, the stock falls off, and then it rebounds, comes back up and touches it, comes down a little bit, goes back up and touches it, and it can't break through that. That's a resistance level. There's a perception that when it gets to that level, there's selling that is always going to come into the market that keeps the price from going above it. So it's very important to understand what support and resistance levels are when it comes to technical analysis, people talking about it. Whether you believe in it or not, that's up to you. It's important to know what they mean when they talk about support and resistance. We're going to watch a video now, and the video is CNBC, who is trying to interpret where the market's been the last 2 weeks. So I don't know if we'll watch all of it, but we'll watch part of it, and if I can bring it up, and we'll see what they're saying about it. This may take a minute. This is like 6 or 7 minutes long, but...
The contract is now more than 300 pages. It's been scanned to the cloud, printed in 3 different cities, copied, revised, and routed again.
Kyocera Document Solutions helps you capture, distribute, and manage the many documents that matter.
It took 8 months to negotiate this deal, and here we go.
So just listen to what he says about the chart.
How can we figure out where the broader averages are headed? You know that one of the key boxes on my checklist for an investable bottom was the technicals. We needed to see the charts turn positive before stocks could start rallying again, which is exactly what happened. But now that we've rebounded nicely, it's time to go off the charts with the help of Dan Fitzpatrick, a brilliant technician who's the president and founder of StockMarketMentor.com, as well as being my colleague at the PaidStreet.com site, RealMoney.com, to get a sense of what could be ahead for the major averages. Fitzpatrick's view, he thinks that we got a classic selling climax, that's a technical term, back on October 15th, when the market sold off viciously, and then we got a dramatic intraday reversal on high volume. Since then, though, the averages have rallied dramatically. And now Fitzpatrick thinks that they've become overbought in the short term, which is something he says strong markets do. But nonetheless, it means we could be due for a pullback. But again, Fitz expects that any pullback is likely to be short-lived, and he says you should buy the dip, even as he believes this market will be range-bound for some time as it builds a base, before ultimately resuming its long-term uptrend. You can see something pretty similar in all the major averages, so why don't we start with take a look at the daily chart of the S&P 500. First, Fitzpatrick points out that the S&P's multi-year uptrend decisively broke down earlier this month. 200-day, multi-year. As the decline picked up speed, it did so on higher and higher volume. This kind of high volume sell-off is always accompanied by significant panic. But when investors panic and dump everything, it ultimately leads to a fabulous buying opportunity once all the bulls have capitulated. We got this selling climax nearly 2 weeks ago on October 15th. And notice, this was always the same day that the volume peaked. Take a look at that. Same day. Fitzpatrick points out that this day, of all of the major indices, reversed at 1:30 p.m. It was as if a massive buy program suddenly hit the tape, or you could argue the sellers probably disappeared. When you take a close look at the action on October 15th, it shows a very long tail. Here, check this out. It's where the S&P fell to an extreme low and then reversed to close near the high of the day. This is one section, okay? Fitzpatrick says that in technical speak, this is what's known as the Dragonfly Doji, D-O-J-I. It's a reliable bullish reversal pattern that reveals a decisive switch from selling to buying, which is precisely what happened right there. Okay? That was it. That was the crescendo bottom, is what I used to call. Now, from that bottom, the S&P 500 has now rallied 9%. At these levels, Fitzpatrick believes it is overbought, at least in the short term. And you can see how trading volume has been declining, indicating that the big boys are not accumulating stock with any particular fervor here. Meanwhile, the S&P has a ceiling resistance at 2020, okay, 2020, and that's roughly 35 points above where we are right now. And Fitz doesn't believe we'll be able to break through that ceiling without first seeing some kind of pullback. So this argues that we're going to retrace a little bit here. At the same time, he also thinks that any decent-sized pullback will be worth buying. When the S&P broke down earlier this month, it fell below its 200-day moving average for the first time since late 2012. But the S&P only stayed below its 200-day moving average for 7 days before breaking back out. There's the 7 fabled days above this key level. That's why Fitzpatrick believes that the S&P 500 should be bought on any pullback to the 200-day moving average, which is slightly above 1900 right now. Next up, how about a weekly chart of the Dow Jones Industrial Average, the vestigial average that I know a lot of you still follow? Okay, just like the S&P, the Dow sold off hideously earlier this month, falling below the 200-day moving average. Okay, 200-day moving average is in red. Fell below that. And it bottomed on the exact same day as the S&P. But the Dow hasn't rebounded back nearly as rapidly. It only rebounded above the 200-day moving average last Friday. And we're still a decent ways off from the Dow ceiling of resistance of 17,350. So will the Dow keep climbing, making higher highs until it tests that resistance line? Fitzpatrick doesn't think so. In his view, it's far more likely that the Dow will fail to tag this uptrend resistance line. Wow. Won't hit it. However, if that happens, Fitz says it's not a sign of a top. It merely reveals that the Dow is entering a period of consolidation. Chartists will sometimes say that the Dow needs to do some work. That is code for it's healthy for the market to churn for a while, flop and chop, I call it, and allow the volatility to subside, enabling investors to regain some confidence that might have been lost during the plunge. So since the Dow has a solid floor of 16,000 support, which is where it bottomed in April, and roughly where it bottomed earlier this month, Fitzpatrick expects the Venerable Index to trade sideways for a while, bouncing between 16,000 and 17,350 as it consolidates. That's the pattern he's expecting. Last but not least, what does Fitzpatrick think about the NASDAQ Composite? Wow. Okay, take a gander at the NASDAQ's daily chart. Fitz notes that before the big breakdown from mid-August through mid-September, all right, from mid-August to mid-September, so you're looking through here, the NASDAQ traded in a tight range before peaking at 4,600, where it put in a short-term double top. Why does that matter? Because that level, where we peaked, can often become a ceiling of resistance. And Fitzpatrick thinks that's exactly what will happen with the NASDAQ. Today's terrific rally took this index right into the battle zone, less than 50 points away from the ceiling at 4,600. Ever since the NASDAQ Composite started breaking down a month ago, all the traders who bought from August through September now feel trapped. They're eagerly waiting for the NASDAQ to return to the levels where they bought it, so they can get their money back without taking a loss. That's the way big traders think. Hey, Lord, get me back to even. That's what you always hear in the trading pits. Given that the NASDAQ rebounded above 4,500 today, Fitzpatrick believes this is about as high as it will go right here, right now, because we have all of this hidden supply from traders who bought at these levels in August and September and are likely to sell, not buy, into any further rally. And that's not the only reason Fitzpatrick thinks the NASDAQ might have trouble heading much higher. The index has advanced early, 11% in less than 2 weeks. That's a terrific rebound, but now the volume is declining. And remember, volume is like a polygraph when it comes to the charts. When the volume is low, it tells you that a move might be deceptively difficult to maintain. Considering the steep rebound from the October 15th low, Fitzpatrick thinks it's going to be tough for the bulls to push this index through the ceiling of 4,600 without first taking a bit of a rest. So, as with the Dow and the S&P 500, Fitzpatrick expects the NASDAQ Composite to consolidate for quite some time. That said, he thinks it's worth buying on any pullback to the 200-day moving average, currently at 4,300, because he doubts we'll be revisiting the October 15th lows. And even if we do, we'll likely rebound from those levels all over again. Here's the bottom line. When it comes to the S&P 500, the Dow, and the NASDAQ Composite, the charts, as interpreted by Dan Fitzpatrick, indicate that after a period of intense volatility, things are about to get nice and boring again, with the averages trading sideways as they consolidate their gains of the past 2 weeks. And any pullback will once again be a buying opportunity. I gotta tell you know what? I find Fitz's benign view pretty reassuring. There's much more money ahead, including the discount air carrier that flew higher today. Should you be booking this ticker along?
Okay, so there's a lot in that, but it's actually a lot of the stuff we talked about. The resistance level, we talked about the moving average being there, breaking down, and all that. And the person he kept referencing is a technician, and that's what his career is he looks at the charts. It's mainly indexes more to speak about the whole market, but it can also be done for individual stocks as well. And they interpret what they think, what it's telling you. I don't know if you buy into all that. I know that a lot of money follows these trends, and because of that, that's why we're talking about it. Is it's stuff you need to be aware of, whether you practice it or not in your own investing. One thing that came up in his discussion was volume. And volume means the number of shares trading that day on any given whatever exchange you're looking at, or whatever index you're looking at, the volume related to the trading of the stocks in that index. Volume is tracked, and it's very important because the more trading that's going on, the more volume that's being that's occurring, then the more real whatever going on is the market is perceived to be. Now remember, for every buyer there's a seller. So it's not that it's the volume of people buying versus the volume of people selling. That's an even number. Volume is the number of shares trading. So it's how many more people might be involved, how much more money is involved when the market's moving up or moving down. And there's just an understood perception that the more volume going on, the more real it is. Something that ties in with that is on the next page of your lecture notes. It's something called breadth, meaning how broad is this market move. And the way they look at it is, at the end of the day, how many of the stocks were up versus how many were down for the day. And if the market, is up today, and they're called advancers and decliners, up and down. If that number's about even, half up, half down, then it's really not interpreted as a strong sign one way or another. The market was up today, great, but the advancers and decliners were about even, so it's not a strong sign. But there are days where the advancers can outnumber the decliners like 10 to 1, meaning almost every stock in the market was up today, and the market was up big today. So when you see that, that's a sign that the breadth is very broad. A lot of stocks participated in this rally, and it's perceived by people as being more real, not justified, but more supported by a broader group of people. And the opposite's true too. If the market's down big on high volume, it's treated as that's a very broad indication that sentiment is bad and the market is headed lower. On this page, I don't know where this came from, maybe out of your text, but you can find it in any website every day. It tracks the stock exchanges, and you can see that the New York Stock Exchange has about 3,000 stocks on it, NASDAQ similar, and on any given day a stock is either up, down, or unchanged, and they keep track of it. So that's what this is, and you can go find this for every day. And so that's what this is telling you. This is the number of stocks on that exchange that were up or down. And then the next part here is issues. Of these 3,000, how many of them hit a new 52-week high today? So people track that as well. 100 stocks did, and only 17 hit a new low. So people track the ratio of new highs to new lows as well. The bottom number here is the volume of shares that traded that day. So of all the shares traded here, this 1.9, about more than half was down. Commensurate with up here, the number of declining was slightly more, but it's about 50-50. So that's what they're doing on this chart. Now, how do people use this? If you go to the next page, I'm going to sort of jump ahead and jump back. your book goes through 3 or 4 sentiment indicators, meaning are there statistics out there that we can track that will give us, maybe not on that given day, but if you look at them over a course of a period of time and we calculate that statistic, is there a trend where this statistic is moving, which tells us sentiment, meaning is it a bullish sign or is it a bearish sign? And one of the more popular ones regarding volume in advancers and decliners is called the trend statistic. And I don't know what that comes from, but what it is it's going to take the number of advancers and decliners, but it wants to take it a step further and ask how strong is that decline and how strong is that advance. So what it does is it marries the two numbers from before. It's going to take the number of shares that were up divided by the number of stocks that were up. That's going to be part of your denominator. And then the numerator is going to be the volume of shares that were down divided by the number of shares that were down. So it's kind of giving you an average volume per share or per company, either up or down. And then you put them together in a ratio. And I'm going to write these numbers on the board. I don't know if you can see them, but there's nowhere, they're not written anywhere in your notes. But basically, the trend statistic for this day is the 1508 volume. Man, there's a lot of numbers here. So you're going to take that number. You might have done this in your homework, and you're going to divide it by the number that was down. And then that's your numerator. And then your denominator becomes the advancers. The volume of advancers was 852, 581, 38. How many of them were advancing? 1455. And when you go through the math of those two numbers, the trend ratio for that day comes out to 1.16. And what it says in your notes is sort of this belief that on a day where nothing's really going on and it's about 50-50, that ratio is going to be about 1. So the higher above 1 that trend ratio gets, the more bearish of a sign that is. The more likely people believe that the market is going to continue declining. Let me show you something here. Let me show you this first. Sometime in the last year or two, CNBC created this board. It's called the S&P 500 heat map. And they go to the board frequently during the day, and it has the 500 stocks listed. Each stock gets a square, and it's 10 rows of 50 probably. And if the stock is up for the day, it's in green. And if it's down for the day, it's in red. And if it's black, it means it's currently unchanged. And what they do is they go to this at the beginning of the day when the market opens, and everything starts flashing green and red. But if you just look at it, it is a graphic of basically telling you advancers versus decliners. And it's fascinating to watch on volatile days because the green and red will change back and forth. I'm not going to do it now, but what they do is they time-lapse this, and they film the board for the course of the day. And then you can watch it back, and they'll give you like a 2-minute spiel of what happened during the day. And you can see how the market turns green and red based on the number of advancers and decliners. The other thing I want to show you is this trend index. This trend statistic, which is we just calculated on the board. You may wonder, like, how important is that? It actually got legs several years ago, and there was a guy named Arms, and he started tracking this religiously to where it has become a statistic, an index that gets put into the newspaper every day. And this website, which I have here, and I believe it's buried in the notes now. It may not be in yours, but I think when I put the notes back on Blackboard, I think I put this link in there. If not, I will. But it's basically stockcharts.com, and it basically explains what the ARMS index is, and it's a tracking of the trend index. And they talk about how to calculate it just like we did. And here's what it looks like. This doesn't mean anything to me because it's not something I follow. But as we talked about, here's 1, and you see that it oscillates above and below 1. And that makes sense, up and down. But over a course of time, a number persistently above 1 is a sign that the market's on a decline. And vice versa. If it's lower than that, then it's the opposite. But I will make sure this shows up somewhere. Here it is again. It is, the ARMS index is quite widely used on the street. Let's go back to the lecture notes. While I'm here, another thing I want to point out to you off that same web page, stockcharts.com has a ton of information on it. If any of you are interested in this arena of tracking charts and stuff, that's a pretty healthy website just because of the amount of information that they give you. Another thing which I haven't brought up, I don't bring up in the notes, is something called Dow theory. Charles Dow, who invented the Dow index, and then his people who followed him, his colleagues and people who came after him, they wrote several letters and papers about following the charts. And back then they were really focused on the Dow Jones Industrial, which is the 30 stock average that we talked about in class. But also there's one called the Dow Jones Transport Index, which is an index of companies that have to do with transportation, mainly railroads, trucking, things like that. And if you think about it, from an economic perspective, it's hard for the economy to take off and do really well without us moving goods around. So how do we move goods around when the economy is really doing well? Is trucking, railroad, all that stuff. So what they tracked is how, the reason they built this index is they wanted to know, they thought that if you tracked the transportation stocks, it would be an indicator of how the economy was doing. And then from that, those two indexes, they realized, moved together. And it makes sense that if the transportation stocks are a component of the index, and transportation is a key part of the economy, and the stock market is going to move with the economy, then those two indexes will do things together and not at times. And that's what the Dow theory has to do with. Once again, any of you who are interested in charting and that, you need to read about the Dow theory because it's probably the most followed charting strategies and stuff like that. It's hundreds of websites. It's mentioned on the TV fairly frequently. And people are always looking for unusual occurrences. So when the Dow and the transport, they diverge, that is a significant moment. Things like that. I don't follow it a lot deeply, so I can't give you a lot of examples. I do know that people track the transportation index more than they track the Dow 30 because they think it's an indicator of the economy. So that's at stockcharts.com as well. I'll make sure these show up somewhere for anyone who wants to track them, learn more about them. Okay, give me a second. We'll get back to the notes here. Okay. So back to this trend statistic is an indicator of sentiment. There's more advancers, decliners. There's more of one or the other. It's a signal of how the market feels. Is it bullish or is it bearish? Another one is the confidence index, and I didn't write it here, but this is put together by Barron's, the publication. Barron's puts out a weekly paper. You should read it if you're interested in stocks. It used to be one of the most followed publications when it came out every Sunday or Monday or whenever it was. They put together through time this confidence index, and it everything else has to do with stocks. This one has to do with bonds, and this is very clever because there's a belief by a lot of people that the bond market knows what's going on well before the stock market does. Meaning, the people who are trading bonds have a belief or they have knowledge of something that's going to happen, so they start trading, and them trading causes interest rates to move. And when interest rates move, it alerts other people that maybe something else is going on, and then the stock market reacts to it and goes up or down. So the belief is, somewhat arrogantly I suppose, is that the bond market is smarter than the stock market. And the bond market will tell you in advance things that the stock market learns a week later. So Barron's said, okay, we'll look at bond data. And what they did is they take a group of basically AAA rated bonds. And they have a group that they've picked out. And they track each week or whatever the yield as a group that group of bonds has. And when things are good, yields are reasonably low. When inflation gets high or when things get more risky or uncertain, rates tend to go up. So that's the first premise, is lower yields is good. Higher yields isn't necessarily bad, but it usually means uncertainty or higher inflation or expectations of higher inflation. So they take those top-rated bonds, and that's your numerator, the yield of them. So it's like a percent, like 5.5%. And then they take another group of what I would call, they call them intermediate grade bonds. They're not junk bonds, but they're not AAA. They're sort of middle of the pack companies. They have some risk to them, so they're not AAA, but they're not junk. They're good investments, and they do the same thing. They take an average yield of those bonds, and that becomes your denominator. So if you take the AAA rated yield divided by the intermediate grade bond yield, you get a ratio. And we haven't talked about bonds yet, but we will. The less risk, the lower the yield will be. So this ratio will always be below 1. Or I would think it would always be below 1. And instead of looking at the ratio, if you just look at the two rates, because they're riskier, investment-grade bonds will trade at a slightly higher yield. And I'm just making this up, but let's say it's 100 basis points, so 1%. AAA bonds are at 5%, and intermediate-grade bonds are at 6%, so that's a spread of about 100 basis points. And through time, that's called the spread. You can graph that, and that spread will be at 1, and then it may get as high as 1.2, then it may get down to like 0.8. There's always going to be a spread between AAA and intermediate, but the distance between that will become less and less as things become more certain, as things become better economically. And the opposite's true. As there's more uncertainty and more perceived risk out there, the spread between something considered very safe, AAA, and something not, will get wider and wider and wider. So that's what happens on a chart of graphing the spread. But if you look at this confidence index, it's a numerator-denominator thing. The spread will as the spread tightens, because things are good, that ratio should get bigger and bigger. Why? Because the spread was 1%, 5/6 is your ratio. As that goes to 0.8, maybe now it's 5 divided by 5.8. So that ratio gets tight. As the spread gets tighter and tighter, that ratio gets bigger and bigger because the spread is going away. So Barron tracks this, and over time, the bond market is telling you a sentiment factor of the higher that number is, the better things are perceived to be. Vice versa, as things are perceived worse economically or a risk uncertainty is developing, the spread of those bonds will widen. So now it's 5 and maybe 6.5. So 5 divided by 6.5 is a much lower number than before, and that ratio is on the decline. So that's another one which is very interesting because it uses bond data instead. I think you probably did a question like that in the homework. You guys are awfully quiet tonight, I must say. I've noticed that. Okay, the last one is the put-call ratio. Getting back to more this related to the stock market, stocks. We haven't talked about options yet. That'll be toward the end. And you can buy options to buy or sell a stock. And it's instead of buying the stock for $90, you can buy an option to buy it later, perhaps, at a certain price for a lot less, $5, $3. And it's really what it is a leverage play on the stock. It's called a derivative. The price of the option will jump up and down based on the price of the stock. But if you want to buy a stock, you buy call options. And if you want to sell the stock, you buy put options. Both of those are contracts which if you buy them, allow you to either sell the stock if it's a put, or to buy the stock if it's a call somewhere down the road. So what people started doing is looking at the ratio of puts to calls. So I don't know what all areas they do this on. I don't know if they're doing it on a certain group of options on indexes or what. I guess you could do it on anything, really. Is just you're looking at the ratio of how many put options have been sold, are outstanding. They're still open. They're contracts that someone has bought and they haven't executed them yet, so they're still out there. How many of those are there relative to the outstanding number of call options? And that ratio should tell you something. If you want to buy the stock, you're buying calls. If you want to sell it, then you're buying, put options. So put options is a bearish sign, some believe. Call options would be more bullish. So as that ratio gets higher and higher, it's telling you that maybe there's more sentiment of being bearish than bullish. The number, they say, oscillates around 65%. I haven't read deeply about this, so I don't know what the range is. But what people are tracking is that number moving up as the week goes along, or is it moving down? And that's what people track with the put-call ratio. Now, you had a homework question, and a couple of you asked me about this. It wasn't the greatest question because it took it another step further, which I didn't really want it to. But it was asking you whether it's bullish or bearish. And it's clearly a bearish indication when this is on the rise. The thing your book tried to make the point of, and I'm going to try to make it here at the end also, is that if this ratio gets really, really high, that means a whole lot of people are bearish and buying put options. And if that's the case, at some point, the market probably overdoes it. So some people, they're called contrarians. They look for things that get extended. So what they're saying there is that, yes, a high put-call ratio is a bearish sign. But if it gets too high, it actually can be a sign that the market has overdone it. So maybe it's a bullish sign, that everyone thinks it's bearish. Now it's time to take the other side. So that's an argument you can have forever. But there is a lot of truth in contrarian, but it all has to do with timing. Are you calling it at the right time? But the point with what the book was making is that this sign, and maybe some of the other ones as well, can overdo it. And when they do overdo it, maybe that's the time when you really should be thinking about taking the other side of the trade. Which goes to my caveat here, is that remember that every time there's a seller, there's also a buyer. So as we were looking at Panera's stock price, or we're looking at some of these other statistics here, you're trying to interpret what's going on, and you're basing it on, if that stock keeps going up and up, you think, well, that's people buying, buying, buying. But just remember that at every point along there was someone selling. Same thing with this put-call ratio. Yes, all these people are wanting to buy put options, which means they want to be able to sell the stock at a certain price down the road. Well, who are they buying them from? They're buying them from someone who's writing the option. And that person doesn't necessarily think the market's going up, but they're willing to write an option because they don't believe it's going to go down as much as all the buyers think. is probably the best way to say it. The point I'm trying to make is that for every trade and every perception and every sentiment, there's two sides of it. Someone else is on the other side. And at some point, the contrarians are correct that if things do get overextended and you end up, maybe these sentiment indicators at some point are giving you a false signal. Okay, the other thing I want to show you is Investopedia has a ton of definitions of all these chart things. So if you're watching the news and you hear someone talking about the charts and stuff, and they say something crazy, you can go here. This actually is a great place to find like the definition, and they usually show an example of it. So it's basically Investopedia technical indicators. Okay, get off here. So one of them I wanted to show you was it's called a head and shoulders chart. So anything that's mentioned in this, you can probably come and find it here. This is a classic definition of a head and shoulders pattern. What does it mean? The stock has been rising. It reaches a point. It comes back down. It hits its resistance level. I'm sorry. It's its support level. Takes off again. Goes up. Makes a higher high, which is a very positive sign. But it reverts back down, hits the support level again, and the next time it goes up, it does not reach that higher high. It sets a lower high right here, and then it starts taking off again, breaking through the resistance level and continuing to go down. You hear this all the time on the news. It's a classic head and shoulders pattern. Here's your support level. Here's one of the shoulders on the side. Here's the other shoulder on the other side. And this higher high that it made in the middle is the head. It's a classic topping out of the market or of the stock. People talk about it all the time when this happens. And when it breaks this support level and starts going down, it usually keeps going down. People who follow this stuff, when they actually happen, they feed the fire because they act on it and they start trading on it. So when it broke through support here, a lot of people started selling it even more because it's violated a technical indicator. Another one I wanted to show you, a golden cross is when, I don't know if it'll show me, okay, is when the two averages cross. When the long-term average is above the short-term and the short-term comes up and catches it and crosses over, that's called the golden cross, and that's a very bullish sign usually that the short-term movement of the stock is very positive. It's like we're entering a new phase of bullishness, they would say. Those were the two. The other one I wrote in the lecture notes here is double top and stuff. That's just when the market hit. I think he mentioned that in the CNBC thing we watched. It hits a top, it goes back down, and hits it again, and then it never reaches it again. A double top is sort of a rolling over thing as well. There's one other. I need to go back to this. Let me see if I can get it here. This is going back to the S&P 500 chart. Let's see if I can get a longer one. This one's actually pretty good. This is 2 years, and I'm going to take all the indicators off. There's other indicators. I'm not going to go through them. But when you look at this chart, I don't have the ability to draw the lines, but you can see that as it moves from the bottom left going up, it keeps making a higher high. And it keeps making a higher low. So as it goes up and hits a new high and it starts to go back down, it doesn't go back lower than it was previously. Actually, I think... see if this shows it better. I want to find one where it actually shows you the lines. No, it doesn't have the lines, but you can see it in this chart really well. It keeps hitting a higher high as it's going along. That is a very positive sign for a stock, an overall market, an index, and a stock individually as well. And then it's making lows here, but they're higher every time. And then we get up to here, it stops doing that, and that's when it keeps coming back and hitting these support levels. And these are all key things that technical analysis people would be gearing on. Okay, I've gone through pages 10, 11, and 12. Next week, we are going to pick up on the next set of lecture notes that I sent you that get into valuing equities. What I want to do now is just briefly bring up the StockTrack website and the thing that you're going to be doing. If you haven't looked at it already, there's a file out on Blackboard labeled StockTrack. We talked about it briefly in class. I went over it. I've added some things to it, and that's what I'm going to talk about tonight. I've changed a couple of the parameters. It doesn't really affect you that much. But what I wrote here at the end is more some guidance to you as to what I'm going to expect from you at the end. So it may change a little bit, but this gives you an idea. Our last class before the test is December 10th. You're going to hand in that night a one-page executive summary of what you learned from doing this exercise. You're going to trade for 5 weeks. The more trades you do, the more you will learn. And what I want you to write up is basically a paragraph of, here's my strategy going in, and I realize it's going to be vague, and you're going to change it as you go. That's what I want you to tell me. You had no idea what you were doing. Then you started getting some traction. You figured out what you wanted to do, blah, blah, blah. You have a paragraph on that. I also want you to keep track of, and your account will do this for you, but I want you to tell me what your best trade and your worst trade was. And I guess I need to do that in percentage terms because you'll be doing different dollar amounts. But basically, I want you to explain to me what worked and what didn't. And if you learned something from that or if it was just pure luck. You can have an Excel spreadsheet that'll calculate it if it's something more complicated. You don't have to. And then sort of following that, I'm curious how much of your trades worked. Did you have one thing that worked big and that was explains your performance? Or was your hit rate really good, where of your trades, 75% of them were positive or really good? And then in general, what did you learn from it? So that's sort of what you're going to be writing up. Keep that in mind as you're doing all this. The more trades you do, the more you can tell me. If you just, you have 5 weeks, you have 200 trades. If you only do, I had a girl once who had 100 trades, and she only used 4. So she didn't really learn a lot doing this exercise. She told me that she was just too scared to do the investing. And I'm like, well, it's fake money. That shouldn't bother you. And she said that every time I posted the scores on the board, she was always in the middle. And that's where she wanted to be. And that's just classic risk aversion there. She did not want to do anything that would put her at the top of it, and she didn't want to do anything that would put her at the bottom. So she actually did really 4 pretty smart trades, and she had a portfolio that moved along. But she didn't learn anything. She didn't buy enough options to see how they work, futures and stuff like that. And that's what you need to do. You have 7 weeks to manage this account. You need to play around as much as you want. The only person who's going to see it is me, and I'm not going to see it because I'm not really going to look into your account unless you go to the very top or the bottom. I might look just to see why, if you want to talk about it or not, but I'm not going to bring it up or anything. This is classic behavioral finance. If you had to put your name on that account and have it posted every day, I think you would trade differently than if you can use an anonymous name. And that just goes back to what we were talking about last week, behavioral finance. But there's that. Things that you need to know is it starts trading next Monday. So we will not meet because we're skipping tonight, and then we'll go to... this will open Monday. You need to start trading. You need to have your account set up. If your account is not set up Monday, I will know it, and you will lose points that you would of this 50 points that are possible at the end. You don't have to do a trade the first day because I realize some of you will be working and stuff. But you need to do a trade in the first couple days. By the end of the first week, your account should be humming. I mean, you should have a lot of stuff going on so that you can watch stuff. And I write here that you do need to own stocks, ETFs, options, and futures. I want you to own, at some point during this, at least one of those. You'll probably own multiple of those. Under options, I would like you to do both calls and puts so you see how they act. And you can buy them in conjunction with each other to see how they act. And we'll talk about that as we go week to week. I do not advise you to buy a bond. It's a 5-week thing. You'll get an interest coupon maybe. Whoop-de-doo. Bonds aren't going to move much. The reason they might move a lot is because of interest rates move a lot. But if that's the gamble you want to bet on is interest rates, then go buy an ETF that moves based on interest rates. Don't buy one individual bond. You're wasting a trade. And then the other thing I want you to do is I want to make sure you short stocks as well. Because we did this on paper during 710. I want you to do it live and to get the other feeling of I want a stock to go down. If you want to build a market neutral thing where you have one long one, you do that. The other thing which I didn't put on here is you need to give me, you're going to give them to me in your problem set. So make sure that in that problem set that you fill out for this week, you have the long short thing on there and you have the stock that you're going to follow. I'm going to take those and put them into a mock portfolio just to see how the class does, those picks do as one group put together. Okay, margin. You can, in Stock Track, you cannot tell it that you want to do a trade on margin, meaning I want to buy 100 shares of IBM on margin. The way the margin works is once you're fully invested, so once you've got your $5 million fully invested, you can keep going beyond that. And actually, let me bring up my account. I think the margin's 50%. So here's my account. Hopefully you can see it. My value right now is $105,000. This is a $100,000 account from long ago. But my buying power is almost $200,000. And what that means is once I get this 100 fully invested, I can keep going and borrow another 100,000, which is basically a 50% margin there, because my 100,000 is going to be my margin that's already there. And that's how you use margin in this. You can't do it on an individual transaction basis. So I expect all of you to have your $5 million fully invested pretty quickly, meaning in the first week or so. If you're not comfortable knowing what to do, then you can put it in an ETF that follows the S&P 500. But get it fully invested. And then for you daredevils, I want you to take it beyond that and use some leverage. Go beyond $5 million to where you have $6 or $7 million to see how that works. The way this works is that something goes really well, you get cocky, and then you keep doing stuff, and then it blows up. And then if it blows up immediately on you, you get gun shy and you kind of stop doing stuff. And what I want to do is smooth that out to where, regardless of what happens, keep trading and keep doing things. If we haven't covered options and futures yet, so during class next time, I'm going to try to give you some pointers there. There's a ton of stuff on the side. I'll talk about that in a second. What I want to show you is if you go, it's very easy to use once you're set up. It'll show you what your open positions are. The only thing I own in this account is 100 shares of IBM, which I bought in my class earlier today, showing them how it works. Right now the market's closed, so I can't do a trade. But all you do is you go into stocks here, and it says the market's closed. You pick which which exchange you want to do trading on. You pick buy, sell, short, or cover. So if you already have a short out there, don't do a buy. You need to do a cover so that they keep those transactions together. And then you just put in the ticker you want to buy, the quantity. Is it a market order, or do you want to put a limit on it? And then you hit preview order. It's not going to work now because the market's closed. And it'll show you what price you would get if you did that. Click execute, and you bought the stock. If you go to options, they're a little more complicated. But it's the same thing. You know, are you going to buy to open a contract, or do you already have a contract and you want to close it, so you're going to sell to offset it? We'll talk about that in class. Quantity we need to talk about in class, because options on a stock, it usually means 100 shares. One contract is 100 shares. Here's all the details that you need to buy the stock. You hit preview. It doesn't give you a bid-ask spread, which is unfortunate, but you hit preview and it will give you the price that I think you're going to get, and then you hit execute and you get it. I mentioned this last time. You have to have volume in something for you to execute the trade. It will not be an issue on your stocks, but when you get into some of these options and stuff, there may not be any volume in that particular option that day, and it won't let you do the trade until there is. The thing I wanted to point out was over here on the side, there's a ton of resources about how to do stuff, both inside of StockTrack and just in general. How do options work? How do you buy a long? What's a covered call? What's a straddle? All that kind of stuff is over here. This is stuff we will talk about in class, but unfortunately we won't talk about it in class until closer to Thanksgiving. So I want you doing trades and options before that. So during next week's class, or email me, I want you to get you up to speed. The place to start is reading this options basics right here. It's pretty straightforward. Get your account set up. On Sunday, get a plan, and then we will. You can start trading on Monday. You'll get a feel for it. Hopefully, technology-wise, we won't have any gaffes. In the past, some people had trouble getting trades to go through, but it mainly had to do with volume. That was pretty much it. If you put trades in Sunday night, if it'll let you, they will execute the following morning. I don't know if it'll let you because our class hasn't started yet, but maybe midnight on Sunday night it opens. I don't know how it works. But on Monday, visit this, put your stuff in, and get going. The sooner you get your feet wet, the better. The more you'll learn. I've had kids start out really slow, and then the last week or two they take off and do 30 or 40 trades, doing all these crazy things. And that's great. If I could get you to do that sooner rather than later, then that's good. I think that's all I need to tell you about StockTrack. Ask me questions if you have trouble setting it up, and once you start trading, ask me questions. Remember, you're not graded on your performance. If you're trying to do something and it's not working, that's frustrating, but it's not affecting your grade, so we'll figure it out. And we'll just see how it goes week to week. The other thing I would encourage you to do is, let me see if I can find it here. There's something called the earnings calendar. You type in calendar, actually, type in earnings calendar. And you can do Bloomberg or you can do NASDAQ. They all do it. But what it is it's going to give you a calendar, and it's going to tell you what companies are announcing earnings on that day. So today, 29th, Panera, I'm not going to go down. Panera probably shows up on the list. Next week, on November 4th, which is Tuesday, guess what company reports earnings? Alibaba. So if you want to take a position on Monday in something, okay, last week when we talked about the efficient market, we decided that it is based on news coming out that is random. And when that news comes out, the stocks go up and down. So one of the most popular, significant news events each quarter is when a company announces the earnings from the previous quarter. So when September 30th ended, it takes them a few weeks to get the numbers all squared away. And now we're in October. Every day, hundreds of companies are announcing their third quarter earnings. And Alibaba is announcing their first ever on Tuesday. And the stock has gone up like 7 or 8% this week in anticipation of that. And my guess is if you bought the stock or shorted the stock, or if you bought calls or bought puts, you will experience some type of ride on Tuesday. And that's what I would encourage you to do, is look at this earnings calendar to see what's coming up. Find companies that you're interested in. Find the ones that you turned into me on that problem set. See when their earnings announcements are, and try to trade around them. Take big positions in things the day before you think news is coming up. If there's a Fed meeting next Tuesday, maybe you take a big position on Monday. But the thing common through all this is I would encourage you strongly to start paying more attention to the news, CNBC especially. Watch it as much as you can over the next 4 weeks, and you will learn a ton. And the more of that you watch, the more it will help you do trades. And once you're doing trades and you see how they work, good and bad, you will learn from that. And that's the whole purpose of doing this. As far as the class goes, you had homework due today. I don't know if you're going to have an online homework due next week. I think you're going to have at least a problem set where you do something with stocks and valuing them. That's what I'm working on. It would be due on Wednesday. We'll have class next Wednesday. If you do have an online homework group, what I'm thinking of doing is putting the ones that you were going to do normally, anyway, still have you do those. But instead of them being due before class next Wednesday, I may have them due like on Thursday or Friday so you can come to class. You can start it before that, but it's not due until after class so that you have a chance to come to class. When we go through the notes, you'll be more up to speed. But I'm not going to make it due the following week because we have to kind of keep these on track. So I may have it you do one next week, but it won't be due till Friday or maybe the weekend. We'll talk about that. Or you want to vote on it now? Okay, show of hands. How many you want? Okay, that's what we're going to do. We got a consensus majority there. Probably what you're going to see is a problem set due next Wednesday, and maybe online homework you can start before then, but it won't be due until after class next week. I think that's it. You have the lecture notes. You've turned in your homework. Look for more. When I post the homework out there, I'll let you know the problem set and stuff. And really, the only thing you have to take care of is the stock track. Get it set up and start trading Monday. I won't see you till Wednesday. If troubles arise, then get with me on Monday and let me know. Or if you're having trouble registering before that. That's pretty much it. I'm curious if you can tell what classroom I'm in. Is this our classroom or am I in a different classroom? So I'll ask you that next week. Hopefully you get to watch the game tonight. Hopefully it goes reasonably well. Hope that was a good decision to let you do that. I think it was. And it's not going to hurt us too much. I think you need to watch this video. That'll knock out some of the pages. Do the homework and we'll be pretty much on track. And I'll leave you at that. So enjoy.